The financial markets are often imagined as places where millions of individuals make small trades that collectively shape prices. While retail investors play a role, the truth is that the majority of trading volume and market influence comes from a handful of powerful participants, the big players. In this chapter, we'll explore who these big players are, what motivates them, and how their actions shape global markets. 1. Institutional investors. Institutional investors are organizations that manage large pools of capital on behalf of others. These include mutual funds, which manage diversified portfolios for retail investors. Firms like Vanguard and Fidelity are among the largest. Pension funds invest retirement savings of workers globally. Examples include CalPERS, USA, and the Canada Pension Plan. Insurance companies invest premiums collected from policyholders to meet future claims. Endowments and foundations, such as institutions like Harvard's endowment or the Gates Foundation, actively invest in global markets. Why they matter: these entities hold trillions of dollars and can move markets when they buy or sell large positions. They also participate in IPOs and influence corporate governance through voting rights. 2. Hedge funds. Hedge funds are private investment vehicles that use sophisticated strategies to generate returns, often with fewer regulatory constraints. Strategies include long-short equity, global macro arbitrage, and quantitative models. Some of the world's most famous hedge funds include Bridgewater Associates, Renaissance Technologies, and Citadel. These funds may take concentrated bets, use leverage, and deploy high-frequency strategies. 3. Sovereign wealth funds, SWFs. These are state-owned investment funds typically derived from a nation's natural resources or trade surpluses. Examples include Abu Dhabi Investment Authority, ADIA, one of the largest diversified globally. Public Investment Fund, PIF, is Saudi Arabia's aggressive vehicle for Vision 2030. Norway's Government Pension Fund Global is the world's largest SWF, with a focus on ethical investing. Why they matter: SWFs have long-term investment horizons and significant influence on capital markets, infrastructure projects, and emerging market economies. 4. Central banks. While not investors in the traditional sense, central banks like the Federal Reserve, USA, European Central Bank, ECB, and Bank of Japan can influence markets by setting interest rates, conducting open market operations, and implementing quantitative easing. Their decisions impact everything from equity prices to currency values and bond yields. 5. Market makers and high-frequency traders, FFTs. Market makers are institutions like Citadel Securities and Virtue Financial that continuously buy and sell securities, providing liquidity to the market. HFT firms use algorithms to execute thousands of trades per second, profiting from tiny inefficiencies. These players contribute to market efficiency, but can also cause sudden volatility as seen in flash crashes. 6. Retail investors. While they may be small individually, retail investors are collectively powerful, especially during market surges like the 2021 GameStop rally. Their growing influence is fueled by commission-free platforms, e.g. Robinhood, eToro, fractional share investing, and access to real-time data and mobile trading apps. Still, retail investors face challenges in access to IPOs, institutional-grade research, and execution speed. The composition of big players differs by region. In the US, markets are dominated by mutual funds, hedge funds, and pension funds. In Europe, there is a large presence of institutional investors and family offices. In the Gulf and Asia, sovereign wealth funds, and government-backed institutions are more dominant. These players don't operate in isolation. For instance, pension funds allocate capital to hedge funds. Central banks influence institutional positioning. SWFs invest in IPOs and global infrastructure alongside mutual funds. Their trades and decisions create trends, dictate valuations, and affect portfolio strategies worldwide. Markets are driven by a few powerful players managing trillions in capital. Institutional investors, hedge funds, SWFs, and central banks dominate trading and capital flows. Retail investors are gaining influence, especially in momentum-driven episodes. Understanding who these players are helps investors better interpret market moves and price behavior. Next up, Chapter 7 explores how stock prices are influenced not just by financials, but by news, sentiment, and psychology.